The number of single-digit PE stocks in the S&P has nearly doubled since the start of the year. There are 59 of them now. So what are some good names to pick up here? Let's go value hunting with Sarat Sethi. He's managing partner at DCLA and a CNBC contributor. Sarat, it's great to see you. And let me just, before we get into the names, ask you about the valuation reset. Is it a healthy thing, or what does this tell you?
I think, we've had such a good run over 10 years, and to get a valuation reset because you're having these things, the Fed is raising rates because the economy's too hot, and unfortunately, we've got these things going overseas. But investors need to see that it's just not a straight line up, and below all this, there are some real companies that we think are selling at some real value right now, especially at these prices.
XPO is the first one, the logistics name. That's been a difficult space, the transportation space. Is this one of the stocks it's single-digit PEs now?
It is actually one of the 59 that you mentioned. I mean, it's trading at 9 times earnings, 6 times cash flow. And you've got some catalysts coming here. They're getting rid of their freight business. They're spinning that off. They're going to sell the European business. It's going to be an asset-light business. They're delevering, and guess what? There's still business out there. It's not like freight has just totally disappeared. You've seen we saw the numbers from the retailers. The consumer is still buying. Companies are still shipping, so less than truckload. LTL is a great business, and the market's brought the stock down over 30% just year to date. So it's a cheap stock on cash flow. It's a balance sheet that's improving, and I think too much bad news has been discounted into XPO.
And JP Morgan, we could say price to book, price to earnings. Why do you think this one is still cheap?
So this is almost on the cusp of trading at single digits. It's 10 times earnings, and it's the premier bank. It's got a solid balance sheet, 3% dividend yield, and Jamie Dimon came out just a few days ago and said, hey, we're spending $17 billion to improve our businesses. We're improving our technology. I like companies that are reinvesting into their business, not just cutting costs. And if you look across their lines, asset management, investment banking, credit is actually not that bad, and they've got credit cards. So I think you've got a global bank with a solid balance sheet, a great management team, trading at 10 times earnings at a price to book at 25%, kind of where it was just 3 or 4 months ago. And you get the tailwind of interest rates. I mean, that's really going to help companies like a JP Morgan that really haven't performed in an environment just like this.
Let me take you off into a stray corner, if I might, Sarat, and that is to ask you your thoughts on retail. Over the past couple of weeks, there have been a lot of sort of conflicting profit reports out of different companies, whether it's Best Buy or Target or Walmart. Yesterday, a positive report, or maybe the day before, on Nordstrom. Macy's moving up higher today. Where are you on retail, generally speaking? And are there any opportunities there that you see?
So I think, Tyler, what happened was when you look at the Targets and the Walmarts, they just didn't have the products that the consumer wanted. The consumer wants the reopening products, the apparel. They want to go out. They don't want to just buy things that they had bought when we were sitting at home during COVID. And that's why you saw Macy's and you saw, the Nordstrom's, like you mentioned, good numbers over there, and a Dick's not a good number. So I think in retail, you have to kind of be where the consumer is going to be. The consumer, as Bob Dahl said, is still strong. They are spending money. They are spending money on apparel. They're spending money on services and on travel. So I do think if you've got the right company in retail and you've got the right company in services, that's where the demand's going to be. And it's really going to be a question of, can these companies keep up their margin, and will the demand stay, especially as input prices and you see more costs coming with other types of inflation.
Are there any single-digit, valuation businesses that you would stay away from?
I think at this time, I would look in some of the technology companies that are more single digits on price to sales, where they don't really have any earnings, where you have declining earnings. That's where I would be really careful, because you can get into that value trap, as we spoke about a few weeks ago. The value trap of single digit multiples, it just means that the E can get even smaller, and then ironically, the PE actually expands. So that's where you have to look at. You have to look at not just the earnings, but the balance sheet to say, hey, as these companies come out and reissue more debt, what is the credit market saying? And a lot of the focus has been on the equity market, but the credit market spreads have been widening. So investors have to be very careful that, hey, if I'm buying an individual stock, let me just look at what the future cash flows are going to be and what does the debt market, because debt market is pretty much always ahead of the equity market.
All right, XPO, JP Morgan, the two names you would pick up here. Sarat, thanks so much. We appreciate it.